Our San Diego County Realtors Young Professional Network is excited and happy to have our favorite tax guy, Jesse Lipscomb, here for our Tax Tip Thursday. I want to thank our sponsor, Jake from State Farm, Jake Caesar. He is local here in Encinitas. He's my insurance guy. He does a great job. So thank you for supporting YPN and being a part of this great organization. And I think I'll just turn it over to you, Jesse.
Perfect. And at 45 years old, you still qualify for YPN.
Yeah. You know, actually, there's no age. You really just have to be young at heart. Just kidding. It's just young and youthful. That's really what it is. We want to be innovative and anyone can join. So yeah, young at heart.
There you go.
So I'll always be a part of YPN.
Right?
I hope.
So Jessica, we're doing our 2020-21 tax update and some tax planning. My background, you guys know, I'm an enrolled agent licensed with the IRS, an investment advisor in California, focused on tax planning for real estate agents and real estate investors. And after we go over an overview of what's going on in the tax prep world, we're going to give you some strategies that directly impact your clients, and then some tax tips as to what my most successful clients do as agents. So what a crazy time last year was tax-wise. Remember, you know, sometime in the spring or early summer last year, people were getting stimulus checks. It should have been $1,200 per adult, $500 per child, but it was based upon either your 2018 or 2019 tax filings. And so some people didn't get them at all. The good news is there's something called a recovery rebate on the tax return this year. And that's just tax gibberish for, hey, did you get your stimulus check? If you didn't get it last year, if you didn't get the $600 in January, then we'll claim that and you'll get that as a forgivable credit right on your return. Okay. Additionally, we just last week, they passed the law where as early as yesterday, it's $1,400 per adult, $1,400 per dependent. Okay. And that is, those stimulus checks are all tax-free to you, actually. So there it is right there, the recovery rebate on the 2020 tax return. This season's really interesting. It started on February 12th. Like you couldn't even e-file prior to then, as opposed to normally it's in mid to late January. Okay, so
I know I was trying to file taxes with you earlier. Remember, you're like, we have to wait a couple weeks. I was like, okay.
Yeah, I haven't seen that in the past, but very similar to last year, they extended the filing deadline. It's now May 17th as opposed to April 15th. Okay, so that gives people another 30 days. This is a big driver to that extension, Jessica. It's the $10,200 of unemployment. If you make less than $150,000, they're making the first 10 grand of unemployment tax free. So that's going to cause a lot of early filers to actually have to resubmit or amend their returns. SBA loans, last year, a lot of folks got the payroll protection program, the new version for 2021. It's not going to be available for most people. And the reason why is you have to demonstrate a decrease in gross revenues either annually or in any quarter, 2019 to 2020 of at least 25%. That's gross revenue, that's not net income. And from what I'm seeing is that this will help like restaurants and stores, but self-employed professionals, it's kind of hard to get. The EIDL loans, 30 years with a 3.75% fixed rate and 1 year of deferrals, that's really a nice bit of additional capital for people that need it. It's usually worth 6 months of your gross income. Then employment benefits just got bumped up now also, $300 extra a week through September. And last year through 12/30, you could take up to $100,000 out of an IRA or 401k if you were impacted by COVID, and who wasn't, right? And have 3 years to repay that. Additionally, if you're in your 70s, now the required minimum distribution begins at age 72. Prop 19, probably the biggest single change in California taxes for 2020 and 2021. The bottom line is, if you look at the BOE's website on Prop 19, you'll see these comparison charts. Prop 19 replaced Prop 60 and 90 and 110, which is the downsize proposition, where you could sell your house, keeping your Prop 13 tax base, go to same or less, and not be reassessed. The nice thing about Prop 19 is that now you can do it 3 times. You can do it anywhere in California, and you actually can go up in value and only be reassessed on the overage. So let's go with an extreme example here. You bought a house way back when for $100,000. It's now worth $1 million. You sell it within 2 years. You buy a new house. Let's say that the new house is $1.5 million. You'll only be reassessed taxes on that difference of $500,000 added to your old basis. Okay, this is probably, Jessica, the most frustrating part of Prop 19, in so much that if you're trying to pass on wealth to your kid or your grandchild, that real estate, rental property real estate, will be reassessed when you pass. And we're going to talk about potential opportunities here. And Blake actually starts off with a good question. And it says, what happens when your family leaves those properties to you when they pass away? So let's talk about that. Blake,
let's talk about it.
Yeah, there are 2 scenarios. Okay, it's mom and dad's house. It's a primary house, and they're going to give it to you, and it's going to be your primary house. In that scenario, we have to look at, and this is a calculator. Jessica, anybody on the call, they can reach out to us or reach out to you directly. This is a Prop 19 calculator that helps you understand the impacts. So here, this tab is for 55 or older primary residents. This is for folks inheriting a home. So in this case, Blake says, let's say it's mom and dad's house, okay? And let's say that they bought it way back when for $32,000, current Prop 13, assessed value only $76,000, and it's currently $1.1 million. That happens a lot. If you bought your house in San Diego in the 70s, it's quite possible it's worth $1 million right now. So in this scenario, the rule is, and I'm going to go back to the slide, it's current taxable value plus $1 million. Purchase price was 32 grand. Prop 13 keeps the assessed value low at 76. If the current market value is $1 million, check this out. If it's just $1 million more, then it does not get reassessed. Currently, they're paying $900 a year in taxes. You inherit it. It's your primary. It's mom and dad's primary. It's your primary. It doesn't get reassessed. But anything over $1 million, so in this case, $1.1 million more, you'll pay current taxes on $100,000. So, you know, it's $1,200, or excuse me, it's $2,100 a year as opposed to $900 a year. No big deal. Okay. However, if it's mom and dad's rental, you're just out of luck. It doesn't matter what the current market value is. It doesn't matter what the assessed value was. If it's not their primary, you're going to have it reassessed. Okay. And so I'm going to transition back to the slideshow because we're going to talk about what to do in these situations. And by the way, what's the purpose behind the law? The purpose behind Prop 19 is pretty simple, and it's dual faceted. First, it's to help people who are 55 years of age and or disabled to be able to transfer their property bases multiple times, whether or not they're downsizing or upsizing. This is a huge win for homeowners. This is it's just, like I said, it's a huge win. It's the best possible scenario for homeowners that want to, let's say you want to downsize square footage, or you want to downsize from dual stories to single story. The problem is you might be downsizing square footage, but you're going up in price. And if you're in that situation, primary residence, you bought your house way back when for $32,000, it's worth $750. You're going up to 1.2. Without Prop 19, you'll go from paying $900 a year in taxes to $15,000 a year in taxes. Okay. With Prop 19, you're going to pay $7,000 a year in taxes. It's still a lot, but it's $8,300 a year less. So that's a big deal. But let's talk about some taxes and strategy.
I just want to interject really fast. You are the spreadsheet king. That I have never seen a spreadsheet for Prop 19, and that is money. And I think everyone in this industry would be happy to have a copy of that. So yep. I'll just say it again, just, write us on Facebook, send me a message, we'll get it to you. I haven't seen that. I'm excited to get my hands on it. So thanks, Jesse, for creating that. That's amazing.
Sure. Hey, that's, the North San Diego County Realtors, right?
Yeah. Giving us value.
There you go.
That's our goal.
So real estate taxes and strategies. Let's start looking at the three IRS codes that most impact us. And when we say, hey, is it a good idea to sell my house today? Can I get a heck yeah? I mean, of course it is, right? I mean,
it is the best time ever. There has never been a better time that I've seen my 15 years of real estate to sell your home than,
I mean, a lot of us lived through the insanities of 06 to 08. That's got nothing on this market. I'm seeing, I don't sell real estate. I advise realtors. They're telling me they can get up to 15 offers on a house. And
I've seen up to 47 offers on a home.
Oh my God. That's crazy. And having to come in with the cash over appraisal. Mm-hmm. So, this is, if you have somebody on the fence, let's give them some strategies to win here. So selling your house, your primary residence, this is section 121. This is the one we always talk about, 2 of 5 years. Okay. But there's some gotchas here. And gotcha number one is, even though it's called 2 of 5 years, it's not really. It's really 2 of 2 years. Because January 1st of 2009, there was a law change where they now introduced the concept of non-qualified use. And it's a few slides from now, I'm going to go over an example. But the bottom line is, if you have a client who has a rental, don't ever tell them to move back to the house to lock in this $500,000 exclusion, because it doesn't work anymore. Okay. So it's kind of a foreshadowing for a few slides. But what about COVID? What about people that bought a year ago that lost their jobs? What do you tell them? Well, the IRS has a couple of exceptions. Number one, if you have to move for work, or you have to move to take care of a family member, or if something unforeseeable happens, such as you get a COVID divorce, oops, or you become eligible for unemployment, right? These things happen. And what's really interesting is, let's say you bought your house for $400,000 in 2020, you lose your job, and oh God, I got to sell my house, but you've got a $100,000 gain. You've only been in the house for 12 months. Well, 2 years is the same thing as 24 months. So 12 months on 24, that's 50%, right? You had to sell your house because you lost your job and you were on unemployment. So 12 of 24 is 50%. Even if you're single, 50% of 250, that's $125,000 exemption, which is more than your gain, ergo no taxes are due. Think about that. If you've got a client who's on the fence whether they're going to sell or not, Ask key questions. Well, you know, when did you buy it? By the way, were you on unemployment at all last year? You know, are you having to move for work or take care of a family member? There may be opportunities there to help guide them in the process. And you're not giving them tax advice so much as asking questions. And, you know, Iris Pub 523, selling your home, has all this information. But remember I told you earlier, don't move back into your house. If it's a rental, it's a rental. Leave it alone. And what I mean by that, you can sell it, but don't think that by moving back into your house, you're going to be able to lock in that $500,000 gain. This is a very easy example. You bought the house in 2010 for $100 grand. You immediately had it as a rental, and for 8 years, it was your rental. Then at the end of the 8th year, you say, well, I want to sell it, so I'm going to move back in for 2 years, primary residence, and then I'm going to sell it last year for $600. Well, remember I said non-qualified use? The IRS is going to say, okay, well, how long have you owned it? 10 years. How long was a rental? 8 years. So 80% of the gain, the $500,000 gain, is not eligible for the exclusion. I don't want to be the real estate agent that I don't want to be the person that tells somebody to disrupt their life for 2 years and then still end up with a $130,000 tax liability. You know what I mean? So
I don't want to be that realtor either.
I don't want to be that person, you know? What do you do? What do you do? Well, the first strategy, the strategy that kind of everybody in the call has in mind is 1031 exchange, okay? The only thing with the 1031 exchange is it can't be on your primary and it can't be on your second home. It's got to be a rental. It's got to be a legitimate rental, okay? What I'm seeing right now are people splitting their gains, meaning you've got $1 million property in San Diego. You talk to a builder in Houston and you pick up 4 $250,000 properties there, okay? And why? Because on the West Coast, East Coast too, but really here, it's all about appreciation. In the Midwest, it's all about cash flow. So you can have that $1 million property with $3 grand a month of rents. That's only 3.6%, right? 36,000 a year on $1 million is 3.6%. You could go to Texas, get a $250,000 home, and get $2 grand a month of rent. And so now you 4 of that, that all of a sudden becomes a great strategy for people, not only for additional cash flow, but here's your first tie-in to Prop 19. What do you mean? Look, if you've got rental properties, you pass away, your kids are going to inherit the properties and be reassessed taxes. So they're going to be faced with an interesting dilemma. Do they inherit the property and get the federal step up in basis and sell it for cash, or do they keep it and rent it out knowing that the property tax basis is going to go up? I think the win-win here is the 1031 exchange out of state. The owner of the property should get higher rents and less maintenance, right? Let's face it, you have a 30-year-old property, you got 30 years of wear and tear, okay? You 1031 exchange that into a new property or a storage facility or something where you have very little maintenance and more cash flow. Then your kids are getting that higher rental income as well. And a lot of times you'll have one rental property with 3 kids inheriting it, which, what are they going to do? Instead, 1031 exchange that into 3 properties, and then each one of the kids can inherit each one of those properties, right? And whether or not they subsequently sell it or not, at least you gave them that kind of inheritance, right? Back to the 55 plus strategy. This right here, you see right there, it says purchase or newly construct within 2 years. I think that is a golden nugget right now for the right person. Okay, let's say you want to sell. You're 60 years old, 65 years old, and you want to sell your house, and you have $500,000 of gain. You bought it for $500,000 a couple years ago. It's worth $1 million now. You want to sell, top of the market. And really what you want to do is you want to travel the country in an RV for a couple of years. It happens. A lot of people want to do that. So you take advantage of the Section 121 205-year exclusion. You and your spouse, you lock in tax-free $500,000. You go get your RV and you have a good time. And then you come back, and whether you buy a house the same price or less, or the same price or more, it really doesn't matter. You'll be able to transfer your old property's tax base to the new property. Now, of course, if it's more than your primary, it'll go up accordingly. But the bottom line is you can lock in $500,000 tax-free, buy another property, same or less, and keep the same tax base. And you got 2 years to do that. So I really think, you know, we've always heard buy low, sell high. It's high. Well, what if it stays high? Well, it stays high. And you locked in $500,000 in your RV. I mean, it has to be the right person. That's kind of a neat strategy. The next part of this is oh, by the way, 1031 exchange out of state. Be careful, be careful, be careful. Okay. A tax return, within your tax return, there are sometimes informational filings. And in one of those cases is California's Form 3840. Okay. All this does is tell California that, yes, you 1031 exchanged out of state and you still have the replacement property. Okay. And you've got to do this forever. Like literally, don't take my words, take the FTB's words. There's the website. It says literally, you need to do this until you either die, donate it to charity, or pay taxes. And I bring this up because if you don't file this informational return, FTB will send you out a love letter called a proposed notice of assessment. Okay. And unfortunately, that love letter, it's going to tell you that you owe some astronomical amount of California taxes. Okay. And you just completely avoid the special attention by making sure your tax person is aware of the Form 3840. Okay. Whew. All right. Third and final strategy for real estate investors. What if you're in a situation where you're tired of toilets, tenants, and trash, and you want to sell your rental, but you're worried about paying capital gains on it? Or what if you're in that situation where, you know, you've got one kid who's not good with money, and you know when you pass away, he's going to inherit that $1 or $2 million rental property and sell it and have $1 or $2 million to get in trouble with. Okay. The old Section 453 installment sale still is powerful. And we used to call this seller financing. And in truth, Jessica, there are some negatives here, and it's okay. It's good. Like, it's okay that there's negatives. What are the negatives? The negatives are, you know, what if they don't pay you, or what if they prepay you, right? Because if, let's say, for example, you had a $500,000 gain on an installment sale, if you got $50,000 a year for 10 years, you would only pay taxes on the $50,000. And the power there is because the tax brackets for long-term capital gains, you pay 0% on long-term capital gains so long as your taxable income is under $80,000. Okay, which is interesting. The standard deduction is almost 25 grand. That means total income, you could make $105,000 a year and still pay 0% taxes on your capital gains. This is very, very powerful. Okay. Of course, in a traditional installment sale, you're getting that 50 grand a year. And in year 3, the new buyer says, oh, I just won the lottery. Here, I'm paying your note off. Now you've got a tax bill. That's no fun. Or they quit paying, and that's not fun either. So I'm part of a nationwide team of financial and tax and legal professional called the estate planning team. And they've trademarked the deferred sales trust. And all this is an installment sale with a business trust that then subsequently sells the property. So it's a concurrent transaction. we set up the trust before you list the property. You sell the property to the trust in exchange for the note, and then at a concurrent escrow, an outside buyer brings cash to the table. So think about it. If you had cash backing the note, you overcome those risks of default or prepayment. And from a mathematical standpoint, look, we saw a bunch of these. There's like this neighborhood in Lemon Grove that people bought for $100,000 way back when, that they're selling for $400,000 right now. If you did that, you'd have a $300,000 gain. Oh, $100,000 at closing. Can you imagine? Right? If you can somehow take that $300,000, get 3% on it, you got $750 a month. Cool. But what if you didn't have the tax haircut? What if you could take almost that entire $400,000 and say on a 12-year note, you'd get $3,200 a month. That's $2,500 a month more. And ideally, if we go back to here, if it's structured right, maybe that money comes out at 0% federal tax, right? So those are three good strategies to help people overcome selling right now: Section 121, 1031, and 453. Shoot. All right, here we are, last section. We're in the tax planning for realtors. And, you know, I had a friend ask me one time, Jesse, what do your most successful clients do? And my answer was one part observation and one part advice. You know what I mean? What do my most successful clients do? Well, the first thing they do is they set up S corporations if they're self-employed, and it's all about control. Will it help you save money in taxes? Oh, sure it will. But it's all about controlling those taxes, because most of us are self-employed, right? Because we like to control what we do, right? We like to be our own boss. The second thing is they utilize, whether it's 401ks or health savings account or even pension plans, they use those tools to do tax bracket planning to save for retirement. Here's an example. They save $10,000 in self-employment taxes by doing the S corporation. And then they take that 10 grand and put it in their own 401k. They're literally taking tax money and saving it. Think about that. And getting a tax deduction to boot. Okay. So then the next thing is they're going to use their good income, good credit to acquire rental properties and or build their business. And as that happens, they're going to make more money, they're going to save more money, and they're going to have more money. Okay. That right there is a trifecta of success. Can you do it in reverse? Can you begin investing in rentals and then later put money into a 401k? Yeah, sure you can. But if you're in that 32% federal tax bracket, my God, you're paying 40% of your income in taxes. You might as well get the tax savings first and then get the cash flow second. So to that end, understanding it, look, the last time you had a W-2 job, you remember they gave you $1,000 in wages, but they took back, Social Security and Medicare and withholdings and everything. These payroll taxes are misleading because they don't tell you what's really going on. You as an employee pay them, but your employer has to pay them as well. So for every $1,000 of wages that you earn, the IRS is actually collecting $153 or 15.3%. And they reward you for taking the risk of being self-employed by giving you self-employment taxes. And now you pay 15.3% tax on your net income. That's no fun, right? To calculate it here, they do some adjustments, but the bottom line is, think about this. First year in real estate, you're doing okay, but you don't really feel the pain. Second or third year, you have that breakout year. You make $100,000 for the first time. You're like, wow, this is awesome. After expenses, you got $72,000. That's awesome. And then they assess $10,000 of self-employment taxes on top of your other taxes. That's not awesome. That's painful, right? Here's where you set up the S corporation. Now, I believe in a 1/3 2/3 salary to profit ratio. And why? Because there's this new 20% qualified business income deduction for being profitable in your small business. And basically to qualify for it, that's the ratio. But do you see here, Jessica, you go from paying 10 grand in self-employment taxes to only $3,600 of payroll taxes on the 24,000. The 48,000 of profits completely exempted from it. And that's 6,500. Well, the best math, and I'll explain for a second. Remember we talked about saving the savings, right? Well, the best math I've ever learned for retirement planning is this: $500 a month, 5% interest, 20 years. You'll notice that 20 years, that 500 a month is 200,000. You do it for 30 years, it's 400,000. And it's linear, which means that if you put $1,000 a month away, that should be 400, that should be 800. But if you understand this, why not get your tax savings to do it for you? Look at this. We just figured out how to save $6,500 a year. That's $500 a month. Put it in your 401k. Guess what? 20 years from now, you've contributed $130,000 for your future that you would have paid in taxes, and $500 a month, 5% interest, 20 years, you should have about $200,000 with earnings. That's pretty cool. By the way, a 401k, everybody listening to this, if they're self-employed, whether or not they have a corporation, if they're just self-employed, it doesn't matter. If you're self-employed, you can sponsor your own 401k. A lot of people think a SEP IRA is the way to go. And I'm going to tell you straight, mathematically, 401k for a one-person operation, like a one-woman operation and corporation, by far more powerful. Why? Because both the SEP and the 401k let you put away 25% of your wages. The 401k, though, will let you put away money dollar for dollar on your salary as your own employee. So, I mean, think about this. 27 grand for your future on a $30,000 salary, that's tremendous, okay? As opposed to just 7,500 with the SEP IRA. Whew, we're going fast. We're covering a lot.
That's incredible. I love that.
Right. Last section here is how do you get in the game? Well, if you're military, they've changed the rules, man. You can now go zero down, and I think it's unlimited as to the value of what you can acquire. So right out of the gate, get that 3-unit or 4-unit building. Become a real estate investor right out of the gate, living in one of the properties, right? You got FHA. I've heard of what the Farm Bureau, I think, has some very low interest rate loans. And remember we were talking earlier, let's say you're putting $20,000 away a year into your 401k, $20,000 a year, 5 years, 100 grand. If you're in the 40% tax bracket, it's going to save you $40,000 in taxes. To say it differently, if you don't do it, you're going to pay $40,000 more in taxes. Okay? Or 100,000 minus 40 would be only 60,000. So at the end of 5 years, you maybe would have $60,000 in the bank versus $100,000 in the 401k. 401k is wonderful because you can borrow half of it up to $50,000 completely tax-free. So what would you rather have? 60 grand after tax or $100,000 with $40,000 of tax savings that you can access 50 grand? I'm going to go with the later, right? It's all about control, guys. And that's how to get your first property, second property, whether you're 1031 exchanging it, or I love this first strategy. You start off with a fourplex. You do that a couple years. Maybe you refinance it, get out of your VA loan, or don't refinance it. And you go into a new single family residence, because from a lending standpoint, it's a pretty easy argument to say, hey, I live in this fourplex. I'm sick and tired of, having neighbors. I want to go to a single family home, right? It's kind of a harder argument to say, I live in a single family residence. I'd love to keep this loan and get a fourplex. they're going to say, well, that's an investment. Okay. Traditionally, a lot of people do cash out refinances and or then 1031 exchanges. Whew. So that's the recap. My most successful clients, right? They control and lower their taxes using S corps, 401ks to save for retirement. They invest for cash flow in rentals and or their own business, right? As we see right here. And a recap of the meeting. Listen, a lot of things are going on with the taxes. If the key is if you're under $150,000 married or $75,000 single, you should expect another $1,400 rebate. If you've had unemployment and you make under $150,000, that the first $10,200 should be, I mean, it is tax-free, but whether or not you have to refile your taxes is another thing. We talked about the various, strategies selling your house right now, integrating in with Prop 19. Oh my God, you lost your job. Well, there's potential help for you as well if you don't hit the 2-year mark. And all about controlling and thriving in your own small business. I'm happy to send anybody listening free articles on tax planning or the tax organizer for realtors, the individual 401k, and that Prop 19 calculator. Happy to do that. And happy to answer any questions if anybody has any questions.
Yeah, send us your questions if anyone has one. I don't see anything going on in the chat.
Oh, here we go. AJ, appreciate the good vibes there. Very cool.
I can check Facebook really fast and see if there's anything there, but I think we're good.
Yeah, it's awesome. Now, I will tell you this resource-wise, we roadmaptax.com, we have a tax blog that, full disclosure, I don't write this. I pay people to write this for me, but it's really impressive. Some of the articles they posted, like, for example, if you're trying to get the stimulus check, okay, well, this is going to talk about how much it's going to be, what your income levels need to be at. You know what I mean? This is very valuable. And if you want to laugh, go to the top here and watch the 7-minute video of how we were visited by a SWAT team earlier this year during a live workshop. That was crazy. And it was all because, look, last year, 2020, tax revenues were down for the taxing agencies. And what are they doing right now? They're being pretty aggressive in their collection activities. The good news is, do the right thing, report all your income, file your returns on time, and you won't have any problems. I didn't have any problems, but they did have a warrant for somebody that wasn't doing the right thing. Yikes. Pretty crazy.
I heard about that. I want to watch it.
It's crazy. If you look at my expressions, so my assistant Rachel filmed this either the same day or the next day. I think it was the same day that it happened. And to look at my expressions, I was like blown away. In 20 years in business, I've had 3 what I'll consider weird situations, right? One super easy. A young guy was in construction. He wasn't paying his bills. I was his registered agent, which no big deal. We were registered agents for a lot of people. But there's a perception that a registered agent is something much more than it is. It's just who gets served when you get in trouble. That's your registered agent, right? So
well, you're my registered agent, I think. So
pretty much, right? And so
let me know.
That guy came in and he was like confrontational, and I just said, "Hey, man, thanks a lot." He's like, well, and I'm like, "I have nothing to do with this. I'm the guy that you give the summons to, so I'll take care of it." And the second one was we had somebody with a corporation that wasn't filing their payroll tax returns every quarter. Okay, sometimes that happens. You probably need to do that or get a payroll service, right? That's something we offer. But an IRS field agent showed up in the lobby, and hey, how are you? Well, you know, come on back. We figured out what was going on. We filed the returns, took care of it. Okay. So far, so good. Never had a whole FTB tax party here in the office. I didn't even know FTB had like law enforcement people, but they did. And
now you do.
now you know. But what I do know is that, hey, stay in compliance with your filing. And if there's one thing I've learned over the last 20 years, always report your income. Okay, so like, for example, if you're going to flip a house and you make $50,000 on it, don't report $50,000. Report the $500,000 sale and the $450,000 of expenses, right? So anyway, like I said, if you guys want kind of a good laugh at my expense, go ahead and watch that. It's very informative. All right, so AJ,
it looks like we gave the people some time to come up with some great questions.
Yeah, that's awesome. AJ says, can you explain the solo 401k again about putting money to yourself as your own employee? Absolutely. Okay, I'm going to go off the cuff here a little bit and show an actual analysis that I do for clients. And hopefully you guys, this makes a lot of sense. So let's just go through, and you'll notice there's a 3-step method right there. Let's say you made $120,000 total income and you had $30,000 of expenses. That's pretty normal. Most agents will have $20,000 to $30,000 of expenses, marketing, vehicle, whatever. So you get your 90 grand there. And you'll notice here at the bottom that we've built in the 15.3% self-employment tax on that 90,000. Okay. Interestingly enough, you're really not paying that much in income tax, but when you bump that with self-employment, man, that's a brutal $25,000 on 90 grand. So first, figure that out. And then second, what is an S Corp going to save you in taxes? And it's literally, I mean, Jessica, it's so crazy. You're just going from self-employed to an S Corp. You're not really, I mean, you're still selling real estate. It's just different reporting. You're going to notice two things. First, S Corp profits are not subject to the 15.3% payroll tax, self-employment tax. However, when you don't pay it, you also don't get the deduction for having paid it. So what you pay 12 grand, they let you deduct 6. That's cool, I guess. You'll notice a lot of times you'll pay more federal and state income tax having an S Corp by itself. But overall, you'll save a tremendous amount of money because you're not paying that big self-employment tax. So the third step of this, and by the way, the IRS doesn't care. They don't care if you have an S Corp or not, but they do care if you have an S Corp. They do care if you don't pay yourself wages. Okay, so this again, you've got 90,000 of profit, so you should have at least 30,000 in salary and 60,000 in profits. Okay, so there's how you pay the wages. Okay, 12 grand in self-employment taxes we're freeing up. We set that up in the 401k. There's your 12,000. Now look what happens. So we didn't do anything. All we did is take money we're going to pay otherwise and put it for our future. As we go through here, what are you going to find? You're going to find that the payroll taxes, the 15.3% tax on the 30 is significantly less than the regular self-employment taxes, and your actual personal taxes will go down. So somebody out there in the audience is probably looking at this and going, wait a minute. If we do this, instead of paying $25,000 out of pocket, I'm going to pay $16,000 in taxes plus the $12,000, to which I would say, you're right. You're absolutely right. But what's better? Is it better to pay $28,000 out of pocket, of which $12,000 is yours, or $25,000 where nothing is yours? What's the difference here? The difference is $3,000 a year. It's $283 a month. Any financial advisor out there that would say to you Well, if you give me $283 a month, I guarantee you'll have $12,000 in your account at the end of the year is a liar. But not if you control your own money, because guess what? If you're just controlling it, that's a 0% return. It's all about control. We are self-employed because we control what we do. We control how we partner and prospect and market, our clientele. Why not control our income and our assets, right? So AJ, the following thought on this is setting up a solo 401k where you don't have employees. It's literally just as easy as setting up any other IRA or whatever. It's just a little bit of paperwork. You just got to make sure you have payroll if you're incorporated. Blake asks a pretty good question. He says, have you seen or heard of anything about the 1031 exchanges going away under the Biden administration? Definite maybe. I've heard them talking about it, but it's not finalized yet. It's not. So as of right now, it's a good thing. And here's what I know: they can't retroactive the exchange, right? So if you do a 1031 exchange right now, even if they make it in 2022, where they're not possible, or they're significantly scaled back, you're still grandfathered in. So I want you to think about the folly in this idea, though. If you have a multi-million-dollar gain and you 1031 exchange that into something else, who loses? Nobody. Nobody loses. You get the opportunity to sell the property. You get higher tax bases and new ownership, probably renovations. And you have somebody that sells, right? So everybody's working, everybody's going well. It's if you don't have the ability to defer your gains, what do? You just keep it. You keep it. You keep your low tax bases. You keep the property. You do the minimal deferred maintenance on it. So that means that you don't have contractors contracting. You don't have real estate agents selling. Like it's fiscally irresponsible to get rid of the 1031 exchange. But again, I don't make the laws. I'm going to say that right now it's just rumors. Okay. AJ says, I'm a new agent. I want to know the best retirement fund strategy for myself. This is going to sound super kind of cocky, but I swear to God, I'm telling you right. Focus on making money. That right there is the absolute best retirement strategy. All the things I'm telling you right now don't really apply until you're making $60,000 or more. Okay. Mathematically, S Corp will break even at $20,000 net, but in order to really thrive and do this, you need to be making at least $60,000 gross income, $90,000, $100,000. The more you make, the more impactful this is going to be. Why? Because of the way the tax brackets are. If you look at, and I'm pulling this up over here, but if you look at the tax brackets for 2021, if you're 2020, excuse me, if you're making under $40,000 single, you're only in the 12% tax bracket. It's after you get 40 grand that you hit 22, and then 163 where it really gets stupid. Okay, married under 80, you're at 12, and over 326, it gets painful. But anything over the 22% bracket, this is where you can have massive tax savings, because it's just not the feds, it's the state too. So I'm going to say, to AJ, listen, if you're making over $60,000 a year gross, set up your corporation, then use the 401k. And if you're not, invest in your business. Right there, invest in your small business, start making money, develop a niche market in real estate, whatever that is, a population like veterans, a property type like multifamily, whatever it is. That's the best advice I can give you. TJ says, I have a question. I have a client who's going to sell a $1 million+ home and move into a senior type complex with memory care. How can that work for any tax deferral? Oh, great question. So I'm going to say in TJ's situation, it's very likely that this person is going to sell their primary residence. Okay. And so you've got a couple of situations here. I'm going back up. I want to share this with you. So the first thing is, if they're selling the property as their primary, they can lock in that $500,000 exclusion married, 250 single. If the gain here is over $500,000, you can pay capital gains taxes even on a primary residence. So what do? In that situation, they'd have to figure out how much the senior living facility is going to cost. But let's say they got the $1 million here. I'll give you a quick example. Yes, I am the Excel king. I did make these.
You are the Excel king. I love it.
Yes, you got it. These are everything. Every one of these tabs are scenarios that I come across. So I make it. So, all right, let's look at this. Here you got $1 million distribution, right, from the sale of the house. 3% note on a 12-year fully amortized note. You got $8,000 a month of income for those 12 years. Now, in TJ's client situation, you got to figure out how much is it going to cost every month. If it's going to cost, say, $4,000 a month, and they're trying to keep their total tax basis low, in a year here, they would be looking at $70,000 of principal income plus $29,000 of interest. That's pretty close to keeping them in the 0% bracket, but they might want to end up doing like a 15-year note. So they've got $7,000 a month coming in for those 15 years to cover the expenses, trying to keep the principal at 0%. Okay. Good news is a lot of the money will already be taxed at 0% because of the $500,000 exclusion. The bad news is the IRS is going to try to tax gains first. So we defer everything over time to lock that in. Okay. I like AJ. So it's time to make some money. You betcha.
I like her too. She's great.
All right.
It is time to make some money.
I think, yeah, absolutely. So here is, again, quick recap. We talked about a lot of stuff. Jessica, I'll send you the Prop 19 spreadsheet. I'll send you the articles. And if anybody needs help from us, pretty easy, roadmaptax.com. We're here ready to help. Just hit contact here and it will go to our client care team. Rachel will set up a call, to help you out.
Wonderful. Well, thanks so much, Jesse. We appreciate it. This was a load of information. I got a ton of nuggets from it. Most of it, I feel like I kind of know all these things, especially I work with you, but I always get something, really meaningful from these things. So thanks a whole lot. I appreciate it. I guess I'll wrap it up. Again, thank you to our sponsor, Jake from State Farm. We appreciate you. We appreciate you, Jesse, and reach out to us if you guys have any questions. I'll send out, I see a couple people asking for the spreadsheet. I'll send that right over to you and make it a great week. Let's go make some money.
Bye now.
Bye.